In this video, we are going to go over how to read candlesticks. So if you're totally new to trading and you don't know how to read candlesticks yet, this video is for you. We're going to be going over all of the basics. I highly recommend pausing this video, taking notes, taking screenshots, and coming back to it as needed, because this is the kind of thing that your knowledge is just going to build up more and more over time. So going forward here. So the first thing that you need to know is that a candlestick represents the time period that you are looking at. So let's say you're looking at the 1 minute candle. One candlestick is going to represent 1 minute. If you're looking at the 1 day candle, one candlestick is going to represent 1 day. And so there are two different types of candlesticks in terms of colors. There's going to be a red candlestick and a green candlestick. So on the left here, you can see this red candlestick. When we have a red candlestick, that means that we closed lower than we opened in a certain period. So let's say we had a red day. So we started the day higher and finished the day lower. On the daily chart, it's going to be a red candle because we started higher, closed lower. And so the wicks, and you can see here, you can see these like little things on the top and the bottom of the candle. This represents the highest point and the lowest point that we got to within a certain period. So let's say it's a red day. We open higher, maybe we go a little bit higher, and that's going to be the top wick. And then where we close is the bottom body, and the bottom wick is the lowest point that we got to in that day. Now, alternatively, and I'll move my camera so you guys can see my screen. On the other side, for a green candle, it means that we closed higher than we opened for a specific period, and that's why it's green. So if we have a green day, so we move up in the market, it is going to be a green candle. The body is going to be where we open down here, and then the close, and then again, the top wick and the bottom wick are the highest and lowest points that we get to in that specific point of time. And again, what measure of time? It depends on what chart. Each candle on the daily chart is 1 day. Each candle on the 10-minute chart is 10 minutes, and so on and so forth. Okay, let's move forward here. Okay. So there's a couple different types of candles that we're going to be looking at. So a term that you're going to want to know is bullish and bearish. A bullish candle, or a bullish direction, means that price is moving up. Now, alternatively, a bearish candle or a bearish direction means that price is moving down. And so when price is moving up, it means that buyers are in control, we are bullish, and most likely we are looking to long, which means that we are looking for price to go up. Now, alternatively, if we are bearish, price is moving down. We are likely looking for price to continue to move down, which means we are looking to go short. So when you say that you are longing the market, it means you are expecting price to go up. When you are shorting the market, you are expecting price to go down. Now there's a couple, let me move forward here. All right, there's a couple of common candles that you have. You don't really need to memorize the names of these, but you do want to just be on the lookout for them. So the first one over here on the left is called a doji candle. And it essentially, as you can see, price moves up and down, but it closes pretty close to where it opens. So in a certain period, whether it be a day, a minute, a week, whatever it is, price didn't really move, which usually means that we're in just a sideways consolidation, and it means that there could be uncertainty within the market. Now, this essentially means that you don't necessarily know what direction it's going to go in. Maybe price is slowing down. And that is essentially represented by this doji candle. The second one is going to be a hammer candle. So you can see here we have a green hammer and a red hammer. Now what that means, and as you can kind of see by the definitions of like what the open, close, body high, body low, for a red hammer, that means that we opened higher, closed a little bit lower, but we went way lower, but we didn't close that much lower, right? We kind of, the open and close are pretty close to each other, and we ended still in red. Now on the other side, a green hammer means that we opened high, we went a good amount lower, but we closed even higher. So this kind of helps you to represent whether or not buyers or sellers are in control. So if we're in an uptrend and you see a green hammer, it probably means we're probably going to be continuing the uptrend. Now, you would never buy just because of that one thing, but that's just an example, right? Now, on the other side, we have an inverted hammer, and that is the opposite. We end up wicking higher, but we close lower. And so again, these are just really common patterns. You don't need to memorize the names of them, but you do want to be aware of them because essentially how far we travel in a specific period, maybe it's a really big red candle or a really big green candle or a really small candle like a doji like the ones on the left here, that tells a story of how quickly price is moving, whether buyers or sellers are in control, and just gives you a good idea of what's happening within the market so that you can make good decisions. So another really big one is a bullish engulfing candle as well as a bearish engulfing candle. And I kind of have a little screenshot of it here, and actually it's the opposite. Hold on a second. Okay, so on the left here, you can see the bullish engulfing candle. We have a red candle, and then the green candle, the one that's the third candle, engulfs, it swallows up the red candle, which again insinuates that buyers are likely in control. On the other hand, a bearish engulfing candle is when you move up and then that red candle swallows up the green candle. Again, sellers are in control. So again, this gives you an idea of who is in control of the market. And when I say bullish engulfing, remember that we're thinking that price is going up when it's bullish. Bearish engulfing, price is going down when it's bearish. So these are just some things to kind of get used to. And I know that this is a lot. I went over a lot in a very short period of time here. Pause this, take screenshots, come back to it. If you have questions, also feel free to join my Discord. I'll put a link in my bio and you can join there. And as you're starting to practice, especially if you're doing futures, highly recommend do not start with your real money. I highly recommend starting with the demo account. If you want to start with the funded account, use code LEXTRADES on funding ticks as well as Tradeify. And then if you have any other questions, let me know. All right, thanks guys.